Hello friends, welcome to AFS, your channel where you learn fundamental principles, tools and techniques of finance that you can apply to achieve your financial goals. Today we'll talk about a very important tool called the risk profiling and how understanding this will help you make better investment decisions. Do you know one of the most important secrets of financial success? Well, none other than Benjamin Graham, in his famous book called The Intelligent Investor, said that the secret to your financial success is inside yourself, and risk profiling is the first step that exactly allows you to do that. That is, understand yourself better. Friends, you would have heard many times that higher the risk, higher is the return. And many of us focus on the return aspect of the investment without understanding the risk tolerance that we have, which then many times makes us lose out in our investment journey. Securities and Exchange Board of India, SEBI, the market regulator, requires all the registered investment advisors to meticulously carry out risk profiling and communicate the same to their clients. Risk profiling enables us to determine what is our optimum asset allocation based on our profiling and how can we tolerate risk better. So let us understand this vital tool.
Risk profiling is a process to evaluate optimum level of investment risk a person is willing to take. Risk assessment or risk profiling technique, as we call it, has two main components. One is to assess the risk capacity, and the second one is to assess the risk tolerance. Now let's understand what is risk capacity. Risk capacity means assessment of your financial risk profile, like what are the sources of income you have, what is the stability of the income, what is your net worth status, what is your saving rate per month, how many dependents do you have, and many other such questions. This will help you to assess how much risk you are capable of taking. One, the risk tolerance, the other part of risk profiling, is the amount of risk an investor is comfortable taking. This is more of psychological risk that you can take and the degree of variability of investment return that you are willing to withstand. So let us understand what questions would help us in understanding our own risk profile.
The questionnaire that we go through is indicated, and all investment advisors will have their own in-house designed questions on similar lines. Before we go through the questionnaire, I want to tell you that you have to be very realistic and honest while answering the questions to assess the risk tolerance. For this exercise, we'll take an example of Mr. Raj, who is a BTech graduate with MBA in marketing. He is of 40 years and he is the sole earning member of his family. He has 3 dependent members on his income. He is employed at middle management level with annual pay of 16 lakhs and has further income of 3 lakhs from interest on corporate bonds and bank FDRs. His net worth position is 40 lakhs and his investment horizon is 3 to 5 years. He wants an investment income to generate quarterly interest. Further, he does not have much knowledge about financial products and financial markets. So, let us go through the questionnaire. On your left-hand side, you see that the questions for risk capacity are given, which are 9 questions. And on the right-hand side, there are questions for assessing your risk tolerance, which are 7 questions. So, let us go through the questions regarding risk capacity. If you see underneath each question, there are 5 options given. You have to select the most appropriate option according to your profile. And against each of these options, there are certain points given. So you have to score yourself based on your selection and key in the point here. So in our present case, Mr. Raj is of 40 years of age and he falls in the band C, which is between 35 to 50. So he scores 3. Let's move on to the next question. Which income level band you fall into? So based on your current level of income, you have to select the appropriate answer. In our case, Mr. Raj has salary income of 16 lakhs along with 3 lakhs of income from other sources. So he falls between the band of 15 to 20 lakhs. So we'll score him 4. So let's enter 4. Moving on to next question. What is percentage of the income generally allocated to saving and investment? Now here, advisor is trying to gauge what is your savings habit. What percentage of monthly income do you compulsorily save? So here you have 5 bands. So if you save, let's say below 15% of monthly income, then you have to score yourself 1. In our case, Mr. Raj has 3 dependents, and so he can save moderately between 25% to 35% of his monthly income. So let's score him 3. Moving on to the next question. What is your current net worth position? Now net worth means your assets minus your liabilities. So what is your asset portfolio? Let's say you have a property. You will assess what is the market value of that property. If you have mutual funds, you will assess what is the value of the mutual funds. If you have FDRs, you will take the value of the FDR, and all your assets you will aggregate and take the values of these assets, which forms the part of your assets portfolio. On the liabilities side, if you have a housing loan, you will assess the value of the housing loan. If you have a credit card debt, you will assess that liability. If you have a car loan, you will assess that liability, and what other things that you owe. All these things have to be subtracted from your assets portfolio or assets value to get your net worth position. Now, depending upon your net worth position, which bracket do you fall under? So, how do you calculate that? Take your net worth amount and divide that by your monthly income. So in case of Mr. Raj, when we take the net worth amount of 40 lakhs and divide it by monthly income of 1,33,000, we almost get net worth as 30 times of the monthly income. So he falls under the band C and scores a 3 point. Let's move on to the next question. How many dependents do you currently have? So based on the number of dependents you will have to select the score. In case of Mr. Raj, he has 3 dependent members, so he scores 2. The next question is, how secure is your current income source? So here, if you're a salaried employee, you have to think about how secure is your job. And if you are a business person, you have to see what are the chances of interruption in your business income to answer this question. In case of Mr. Raj, let's assume that he has moderate level of security. So we'll score him 3. The next question talks about what is the time limit of your retirement? So in case of Mr. Raj, he is 40 years of age and he has next 20 years left to retirement. So he scores 0.4. Depending on your time limit to retirement, you select the most appropriate option. Moving on to next question. This question talks about how long is your investment horizon. That is, the money that you want to invest will not be required by you. So this question assumes that you have provided for emergency fund and short-term needs. So depending on what is your investment horizon, as short-term, medium-term or long-term, select the appropriate answer. In case of Mr. Raj, he is comfortable to have an investment horizon between 3 to 5 years. So we will score him 3. The next question talks about in which of the following options you have made highest investment till date. Now here the question asks about what kind of investments you have made till date. So in our case, Mr. Raj has made primarily investments in bank FDRs and corporate bonds. So primarily because he is a conservative investor, he invests in bank FDR. So we need to score him 2. Based on your investment portfolio, you need to select the appropriate answer and select the appropriate points for yourself. So the total score on risk capacity for Mr. Raj is 27 points. Let's move on to understand the questions that are for assessment of risk tolerance. The first question under risk tolerance is, how would you rate your knowledge of finance and financial products? So based on your knowledge of financial markets and financial products, select the appropriate answer. In our case, Mr. Raj has somewhat knowledge of the financial products, so we will score him 2 because he has beginner's level knowledge. The next question talks about what level of risk are you willing to accept on your investments. So this question wants to gauge what kind of investor you are. Are you a conservative investor or are you happy taking more risk? So based on your risk tolerance level, you need to select an appropriate answer. Please be very truthful to yourself. In case of Mr. Raj, he is a person who wants to protect his capital because he has many dependents on him and he also needs a stable stream of income. So he is only comfortable taking a small degree of risk. So he falls under point B and we have to score him point 2. So the next question is, how likely are you to stay invested if your investment shows a loss of 5 to 10%? Now this is a very tricky thing. So if you are a risk-averse investor and if at the very first sight of loss you are going to sell your investments, then you need to select the first answer. That is, you are very unlikely to stay invested. If you are happy staying invested even after seeing this drop and your investment horizon is to bear the loss up to 1 year, then you have to select point C. Or if you are a very risk-taking investor where the likelihood of you bearing that loss can be over 5 years, then you need to select option E. So depending upon your risk-taking capacity, you select the option. In case of Raj, he is very unlikely to stay invested if he sees a loss. So he scores 0.1. Moving on to the next question. How likely are you to stay invested if your investment drops in value by another 10 to 15% in the short term? So this is a follow-on question to the earlier question. Will you sell the remaining investments quickly? Sell a portion of the remaining investment and cut some of the losses? Or hold investment and sell nothing and wait for market conditions to improve? And the last option is invest more funds so that you can take the benefit of averaging. So Mr. Raj is a person who would have sold all the investments at the first sight of loss. So this question does not apply to him. So you would score him 0 here. Let's move on to the next question. What are the returns expectation that you have from your investments? So based on your return expectations from your investment, you have to select the appropriate answer. In case of Mr. Raj, he wants a steady income stream. So he should be happy with 8% to 10% kind of income level. So we'll score him 2 here. The next question is, how long have you been investing in the market? So depending upon your market experience or the market cycles that you have seen, you need to score yourself. Since Mr. Raj has been serving for past 20 years, but he has not ventured into financial markets. His investments are restricted to bank FDRs, so we will score him 1. Depending upon your market experience and experience of financial products, rate yourself. The next question is, look at the 5 scenarios given below and pick one that best describes your risk range. So here there are 5 investment scenarios given with estimated losses during bad times and profits during good times. So based on your risk appetite, you need to select the portfolio that you like to invest in or hold on. So let's say if you are an investor who likes risk taking and you can bear up to 50% of loss during bad times and want to have a capital appreciation up to 30%, then you will select an investment option as investment portfolio E. But since Mr. Raj is a risk-averse investor, he will be happy taking only minimal profit along with a minimal loss. So we will score him 1. So the overall score that Mr. Raj has on risk tolerance is 9, which makes his total score of risk capacity and risk tolerance to 36. So 27 on risk capacity and 9 on risk tolerance. Now let us move to map the risk profile with the types of investors. These are the types of investors, and the scores obtained from risk profiling and the description of the investor. So let's go through them. The types of investors are defensive, conservative, balanced, growth, and aggressive. So a defensive investor is described as a person who has high priority for safeguarding his capital and has a very low risk appetite. He's happy making a very low return on investment. The next is the conservative investor. So conservative investor primarily seeks income with some potential for capital growth. He prefers low volatility on his investment and therefore is willing to accept lower returns. The next is the balanced investor. The balanced investor is a kind of person who wants both capital appreciation as well as security on his returns. So he is prepared to take some short-term risks in order to get capital appreciation in long term. The next is the growth investor. As a growth investor, person understands the nature and the movements of the market. He is interested in maximizing his long-term investment and is happy taking calculated risks. The last category is the aggressive investors. You can call him the manja hua khiladi. He understands the market in and out, and he has a broad experience and strong understanding of market forces and financial products. He has a strong bias towards long-term capital appreciation. He is willing to accept a lot of volatility on his returns in the short term for maximizing his profits in the long run. So these are the profiles of different kinds of investors. In our case, Mr. Raj has scored an overall points of 36. So he falls in the category of conservative investor. In similar fashion, after understanding your risk profile, you can understand what type of investor you are. In our next video, we'll talk about what is asset allocation and the strategy to be followed based on one's risk profiling. We'll also talk about different asset classes as well as the long-term returns that these asset classes have generated in the past. Thank you for watching this video. Take very good care of yourself. Thank you.